Good morning, everyone. Welcome to 2022. Welcome to Monday Minutes. Is anyone really surprised with the price action to start this year? The party's over, right? The liquidity party that we've seen over the last 2 years. You look at Bitcoin, you look at meme stocks, you look at NASDAQ, long duration assets, low interest rate, thriving liquidity, thriving pocket of time is shifting gears. And it's shifting gears really, really quickly. I've got this Christmas tree behind my back, still up to start the year. I told my wife, not taking that tree down until 10-year yields hit 2%. I said, I have no clue when 10-year yields are hitting 2%, but I'd love to keep that tree up all year. And last year, we would say certainly plausible, right? We peaked out around 175, 180, but this is a far different year. The false alarms in the first quarter of 2021, vaccines, growth, inflation expectations moving higher, nominal yields moving higher, real yields moving higher. False alarm, right? The Fed took back control. Powell took back control. Then we had Delta variant, Omicron, obviously now. But why are 10-year yields moving higher? We have Omicron. We have ISM inflations that are turning over. Meanwhile, we had ISM prices paid back in the summer of 2021 at 91, all-time highs. 10-year yields are at 125, right? So this is a market that's cloaked in excess liquidity, cloaked in this dynamic of variance, one stage to the next. Now we head to 2022, and the dynamics couldn't be further from reality. The market now coming to this notion of a faster timeline. We've written extensively, starting in 2021, about how far behind the Fed is, not necessarily on the broader curve, which we can talk about, but what about this notion of emergency conditions that were put in place in March of 2020? So we're peeling those off, and we've been peeling those off way too slowly. So the Fed made this strong pivot in late 2021. We had a strong call first week of this year. Thank you, Market Watch, Bloomberg, and CNBC for covering us. We thought 10-year yields would reprice to the highs of 2021 within 1 week. But the reality is all rates are really still too low. If you look at real yields, dramatic move, with the Fed now saying not just rate increases and the market pushing those increases further, with March now live, it's alive, and balance sheet runoff far sooner than people expected. Real yields can move another 25 basis points from here, less negative, without blinking an eye and without really, this is not even interesting at the point we're at right now. So we've got a long way to go to potentially get to positive real yields. And the liquidity is going away. March, the $120 billion a month buyer is going away. Do people not realize what that means? And I suspect not. So the bigger picture here is really about that terminal funds rate. The market is saying by 150 to maybe 175, the Fed's going to break it, just like they did in 18. They're going to run off the balance sheet, raise interest rates. They're going to break the whole market. Powell's going to come back with the put. But where is that put struck? We have headline inflation running 7%. We get another CPI, PPI this week. We do think inflation will top out, likely in and around these levels, but where are we going to temper to? That's the question, right? The Fed thinks we're going this nice glide path back down to 2%. It's not going to happen. So the Fed is going to be challenged with inflation overshoots now going forward relative to their framework change in August of 2020, which the timing could not have been worse, given the dynamics now that we're seeing in terms of the pandemic and some things that will be transitory, but a likely structural shift here, in particular on the wage side, which is going to keep the Fed on their toes for some time coming. So now we have March almost fully priced, 3 to 4 rate increases for 2022 seems to be growing in consensus. Where does that terminal funds rate get to? That's the question. And we're looking at long end rates here battling in and around 175, 180 in 10-year space through these levels. Certainly a move to 195, 2% is well within the reach of where we were pre-pandemic. Certainly now the inflationary dynamics far in excess of where we were then. And the employment market, as we see on Friday, continues to reflect a very, 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 very tight labor market. This week on the ground, CPI, PPI, we get Michigan. We also get retail sales. Close eye on both the hearings for Chair Powell and Fed Governor Brainard. And certainly eyes on the two of them in terms of pushing back on some of the market pricing right now. But what can the Fed do? And markets are reflecting that. We have extreme inflationary dynamics right now. The Fed took their time getting to where they've gotten to now. They don't have the luxury anymore. So, things will change in the course of 2022. But right now, the sentiment is certainly same playbook, relatively speaking, quicker timeline. Additionally, we also get long-end Treasury supply. Certainly, these are at some of the most attractive yield levels, certainly in 10 years, that we've seen over the past year. So we'll be watching that closely to see what demand shows up. So wishing everyone a great 2022. There is so much ahead of us. Wishing everyone a great, successful, and healthy year. I'm Greg Faranello, head of U.S. Rates for AmeriVet Securities.